Okay, so down to our last chapter and our last test and our last everything, right? So just as a reminder, today we'll talk about chapter 24, and then next week on the 20th, we will review chapters 23 and 24 and kind of really wrap up because we're really pretty much finished at that point. So the only thing we'll have left as of due after Thanksgiving. So the 20th will be next Wednesday, and then the week after that, of course, we have the whole week off for Thanksgiving, so we will not meet. And then I probably will not be here on the 4th because I have a kid conflict. So next week will probably be our last meeting. But I think we'll have everything done and wrapped up because really all that you'll have on the 4th is just due dates. So you'll have the Unit 4 test over 23 and 24, and then the data analytics project. At that point, we'll be done with everything, and so the only thing left would be like an optional final if anyone needs it to replace a low or missing exam grade. I do believe I went in and got rid of like 2 questions on the last exam, so you might have seen a slight bump in points. Pretty sure I did. To remember. I went in and looked at like 3 different classes, so. Do what?
You probably did.
Yeah, I think I did.
Because I got a notice on my email.
That your grade changed. Yeah, I thought I did. I think I got rid of like 2.
A week later.
Yes. Yeah. Well, it was so weird. Normally I can go into the grade book and do like analytics where it shows me how many questions, like if everyone got 1 question wrong, I would see that, and so I could just throw it out. But it wouldn't pull the analytics for all 5 of you. It was only pulling 2 students. And so I just went in and kind of looked at everyone, since there's only 5 of us, to try to see which ones to throw out. But it was really odd. That's why it took me a while, because I kept waiting. I'm like, oh, it'll update. It didn't update. So I just did it myself. So yeah, I think I threw out 2 questions, if memory serves. So hopefully you saw a little bump in that. And then we'll have our final exam, and then that data analytics project is the last thing, wrapping it all up. Yay. Any questions about schedule or anything? Okay, awesome. Let's see, other announcements. I know Megan's already heard this, but you may have heard it in other classes. Course evaluations are live for all of your courses, so you should have received an email. And then also I made sure in our course, you'll see like right under announcements is a course evaluations link. If you click on that, you can go in and do your course evaluation for all of your courses. Again, that's just information about how you felt about the course and me. I do not see that until after grades are finalized and done and all of that. Plus it is anonymous. Obviously it's a small class, but it's still anonymous, and computerized makes it even more anonymous since I don't even see handwriting or anything. So that's out there. I welcome your feedback. Please do take a few minutes and fill those out. I do read them and I do take them into consideration, so I appreciate constructive criticism of the course, what you liked, what you would like to see as an improvement. And so that's an option out there. I think they didn't tell us when the closing date is, but it's usually like right before finals. So I imagine it's open at least the next couple weeks. And then other than that, we are ready to get into chapter 24. So I'm going to open the chapter 24 practice. Okay, sure. Have everything. Okay. So in chapter 24, what we're looking at here is making just a lot of differential analysis. So we're looking at making decisions within the company, and instead of just making a decision, we're actually going to look at the change in cost and income with choosing one alternative over another. So this whole chapter really is looking at alternative actions that we can choose and making a decision based on data that is relevant and important to us. So it's important to kind of understand some of the terminology. And I have this in your notes, like differential revenue and differential cost. It's just the amount of increase or decrease that we see, that we expect comparing one action to another. So when we're talking about differential revenues, we're talking about a change in revenue from one action to another, and same with the cost. So what's the effect of choosing one action over another? And we're going to look at different things like, should we continue making a part, for our product, or do we buy it? Do we lease equipment or do we sell it? Things like that. So we're going to compare them and see which one results in, of course, the better income or, less loss, usually better income. And then we're going to need to know what sunk costs are. Sunk costs are costs that we have already spent. It's a cost that's already been incurred. It doesn't have any effect on our decision. So, for instance, if we're looking at should we take a product that's already been developed and process it further, or should we just stop and sell it as is? Well, the cost that we've already incurred from purchasing the materials to make that product is a sunk cost. It has no relevant bearing on should we, sell it as is or process it further. So those are things we want to consider as we go through and calculate this differential analysis. We would also want to consider opportunity costs. So opportunity costs are just any income that we would lose from choosing one alternative over another. So if we choose, to, not process the items further, or if we choose to process them further, we're taking up factory space that we could possibly use on another, product or something. So that could be a lost opportunity cost. So those are just some of the terminology that we want to consider. And then last but not least, we'll look at special orders. So a special order is when someone offers us less, profit than we would normally take. Well, a lot of times, if say we sell an item for $10 an item, and someone says, well, can you make us 500, but we'll pay you $7 per item? Our gut instinct would be to say no, because we're making $3 less per item. But what we're going to do is look at, as long as we're covering our fixed costs, or not our fixed costs, but our why did my mind just go blank? As long as we're covering our variable costs. See, I'm just getting it all wrong. Fixed costs we know we pay regardless. So as long as we're covering all of our variable costs and we're making some money, then we're going to take on that special order as long as we have capacity, because we have to pay rent, utilities, all of that regardless. So those are considered irrelevant costs in that situation. So we're going to look at that example. So all of these are just looking at different situations and choosing the best alternative. So this first one's a lease or sell alternative. So it says McFadden Company owns equipment with a cost of $475, has accumulated depreciation of $280,000. This equipment could be sold for $175,000 less a 7% sales commission. Alternately, they could lease the equipment for 4 years for a total of $180,000, at the end of which there is no residual value. In addition, repair, insurance, and property would be $35,500 over the 4-year lease. So we want to look at what is our differential income between these two alternatives. Okay. So again, we've already purchased this equipment. That $475,000 that we spent to buy this equipment is an irrelevant or sunk cost. We have already spent it. We already own it. It doesn't impact either alternative. So that one we don't have to worry about. So what I would look at is, well, what are my revenues and costs and my income or loss if I leased the equipment? Well, if I leased the equipment, it told us we could lease it for 4 years for $180,000. So my revenue in that situation would be $180,000. However, it would cost us $35,500 in repair, insurance, and property tax. Okay, make that bigger. So in this case, to lease it, our income would be 180 minus the 35,500, or 144,500. Okay, so if we leased it, we would make 144,500. If we were to sell the equipment, well, they told us we could sell it right now today for 175,000. 175,000 would be the revenue, but we have to pay a 7% sales commission. So 7% of 175. So it would be, the cost would be a minus 12,250. Okay, so that's 7% sales commission. So to sell the equipment, we would actually make an income of 162,750. 162,750. So obviously, which alternative should we choose? Yeah, to sell it. And we're going to look at, the actual differential revenues and costs and income in this situation. But it's pretty obvious we are going to make more income if we sell it, so we're going to choose to sell it. But we do want to calculate the differential effect on income. So we are going to take, we're actually going to look at all our alternative 2. We're going to take alternative 2 revenue minus alternative 1 revenue. Okay, so alternative 2 revenue minus alternative 1 revenue, because they want the differential effect on income for alternative 2. So if we were to sell the equipment, we would make 5,000 less in revenue. Our differential revenue is minus 5,000. However, for our expenses, our costs, we're actually saving costs, right? So I take the difference there, and it's 23,250. It's a positive difference. So we have a minus 1250 minus, or 12,250 minus a negative 35,500. So you'd really just take the difference there. It's a positive difference. And then our income is greater by 18,250. Okay, so our differential income by choosing to sell the equipment is higher by 18,250. And we already said we obviously should sell that equipment. Okay, so in this case, it's just remembering we want to figure out the differential effect on income by if we chose alternative 2. So that's why we take alternative 2 minus alternative 1. I think that's probably the only tricky part. Any questions on that? Okay, good. So a lot of these are somewhat similar. We're doing the same kind of process. It's just with different decisions. And these are all decisions that companies make on a normal basis. So, for example, we have discontinuing a segment. We have product AG52 has revenues of 748,000, variable cost of goods sold of 640,000, variable selling of 90,000, and fixed costs of 50,000, creating a loss from operations of 32,000. Well, again, when management looks at that upon analysis, they would say, well, we're losing $32,000. We should discontinue this segment. But what they need to look at is, are we having to pay that $50,000 in fixed costs regardless? Because if we are, it's not a relevant cost to determining if we should discontinue the segment. We have to pay that $50,000 regardless. So what we're going to do is show, well, if we choose to continue project AG or product AG52, we leave out that irrelevant or that sunk cost of 50,000 fixed costs. Are we actually seeing, some return on this product? Okay. So what we're going to look at is continuing product AG52. Well, they told us our revenue would be 748,000. 748,000. And they told us our variable cost of goods sold was 640,000. So I put a minus 640,000. Variable selling costs or selling expenses were a negative 90,000. 90,000. And we're going ahead and going to put in the fixed cost here, just to show, okay, the difference. So a negative 50 for fixed costs. So again, all total, they're showing a loss or a minus $32,000. That's what they already knew. So that's alternative 1. On alternative 2 is to discontinue it. Well, if we discontinue it, then we have 0 revenue. We have 0 variable cost of goods sold, 0 selling expense, but we still have that fixed cost of $50,000. Okay, fixed cost of $50,000. So in that case, if we discontinue product AG52, we are going to have a loss of $50,000. Okay. So basically what we're saying is the differential effect is just the revenue minus variable costs. Okay, so 748,000 would be the revenue, or minus 748,000, I'm sorry, since we're taking alternative 2. So minus 748,000 in revenue. But we would save, if we discontinued, we would save 640,000 in variable costs and 90,000 in selling. So that results in an 18,000 income that we see there. That should be a negative 18,000. Like they don't have that entered in, but that would be correct. If we chose alternative 2, we would have a negative 18,000 loss compared to if we continued it. So in other words, if we continue the product, we're at least making 18,000 towards, covering. Well, we're at least making 32,000 towards covering. Or no, I'm sorry, I'm saying that backwards. My brain just like flipped out on me. We're at least making 18,000 towards that 50,000 fixed costs by continuing this product. Okay. So then, should we continue making it? Yes. It should be continued because we've seen now that if we discontinue it, we actually see more of a loss. We would lose another 18,000 in income if we just discontinued it. So again, in this case, that 50,000 is a sunk cost. It's irrelevant to the decision. And so we could look at that and see that if we threw that out, we were actually making 18,000 by producing that unit. Okay. All right, any questions on that one? Okay. We'll just zoom right through these, right? Yeah, they're not too bad as long as you have the charts and you just.
Yeah.
It's not too bad. Because they're all kind of similar, just putting in the right numbers. This one's make or buy. So in this case, we have a company manufactures various sized plastic bottles for its medicinal product. The manufacturing cost for small bottles is $75 per unit, and that's 100 bottles. That includes fixed cost of $28 per unit. A proposal is offered to purchase small bottles from an outside source for $40 per unit, plus $4 per unit for freight. So it says prepare differential analysis to determine whether we should make or buy the bottles. And again, we're going to assume that fixed costs are unaffected by the decision. So fixed costs are something we incur under both alternatives. We're going to list them under both. So again, well, if we make the bottles, it's a bottle that we're making for another product. So are we making any sale on that bottle? No, there's actually no revenue or no sales involved with this one. Okay, so it's really just costs. We're looking at cost here. Well, if we make it, then obviously the purchase price is 0 and the freight is 0. And then they told us variable cost is $47, or well, $75, but that includes $28 in fixed overhead. So if I take 75 minus 28, that would be $47 in variable costs. Okay. So all total, we have $75 to make this unit. 47 of that is variable, 28 is fixed. So right now, our total cost, our total loss is $75. Okay, we want to compare that to buying them. Well, in this case, our sales price is still 0. They told us our purchase price was 40, so minus 40. And then our freight is $4, so minus 4. There's no variable cost since we're not making it, but we still put in the minus 28 for the factory, the fixed factory overhead. We have to pay that regardless. So then we have all total, it would cost $72, a minus 72, to buy the bottles. Okay, so it'd be $75 cost to make, 72 to buy. So should we make them or buy them? Yeah, we would buy, right? It's $3 cheaper per 100 units or per 100 bottles. So in this case, it's actually cheaper to buy than to make the bottles. And again, we could look at the differential effect of choosing alternative 2 to kind of solidify that. Again, there's 0 sales. Well, the purchase price would be a minus 40, and the freight would be a minus 4. We'd be saving $47 in variable costs, and the factory overhead has no bearing. So again, there we can see a minus 44 total plus 47. Our income, or I guess you'd call it income, our savings are $3. I wouldn't really call that income, but it works, right? It would affect our income, though. So I guess that's the truth. The differential effect on income would be $3 per 100 bottles. So in this case, we should buy the bottles. So again, you can kind of see the importance. You know, we wouldn't always have to do the tables to figure this out, obviously. But I think it's a good way to visualize what's going on and see, okay, well, you know, that fixed factory overhead, I have to pay it in both alternatives. So it becomes really an irrelevant cost. It shouldn't affect when I'm looking at it. Because most of the time, a lot of times managers would just look at, well, I'm paying $75 to make bottles and it costs $44 to purchase them. So obviously I need to purchase those, right? But that's not a true comparison. Any questions on that one? Okay. I think we're like halfway through, right? Maybe more than halfway through. Okay. And the next one is looking at the possibility of replacing equipment, which again is a pretty normal business decision. We're looking at, you know, we have this older equipment. Well, if I could sell it and upgrade, obviously, and it's going to, you know, save me an efficiency in the factory. But we have to look at, is it really cost effective? So it says a machine with a book value of $80,000 has an estimated 5-year life. A proposal is offered to sell the old machine for $50,500 and replace it with a new machine at a cost of $75,000. The new machine has a 5-year life with no residual value. The new machine would reduce annual direct labor costs from $11,200 to $7,400. So is it better to continue with our old machine or to, you know, spend the money and replace? I think I skipped one on my practice there. That's why I thought we were further along. So we are going to compare continuing or replacing. Well, if we continue with the old machine, there's no proceeds from the sale, right? That would be 0. Our purchase price is an irrelevant cost because we've already purchased that old machine. It does have no bearing. But what does matter is direct labor, okay? So we would want to calculate the cost of our direct labor for 5 years. Well, we're going to go off of the original. They're telling us, you know, right now we're paying $11,200 in direct labor costs. Well, for 5 years, because we're talking about this has a useful life of 5 years, and that's how long we would use it if we continued, or we would at least continue for now. So we're actually going to take 11,200 times 5 to get our total direct labor for 5 years. That's a minus 56,000. So the cost of continuing with the old machine will cost us $56,000 over 5 years. Well, if we were to replace the old machine, we would sell, or sorry, yeah, if we were to replace it, we would sell it and make $50,500. They told us that. So that's a revenue, that's a proceed, $50,500. But we would have to buy new machinery, a minus $75,000, a minus $75,000. And we would still have labor costs, right? In this case, though, it'd be reduced, so it'd be $7,400 a year. So we would take 7,400 times 5 for direct labor for all 5 years. It'll be a minus 37,000. So to replace the old machine, it's actually going to cost us a minus 61,500. Okay, so it cost us minus 61,500. Well, we can see it would cost more to replace than to continue with the old machine. But let's just see the effect. Okay. Well, we would see an increase in revenues by choosing alternative 2, the 5,500. But we'd also see an increase in the purchase price. So we'd see that minus 75,000. But we would see a decrease in direct labor, right? It goes down. It goes from 56,000 to 37,000. So we have a positive impact on labor. So we add all that up, and the differential effect on income is a minus 5,500. So we would actually be paying $5,500 more, or it would affect our income by $5,500 more by replacing this machine. Okay. So in this case, we should just continue with what we have. Now again, this would be a situation, you know, we could reevaluate in a year or two. As that machinery ages, it may cause us more costs in the future. You know, what if it breaks down and we have to fix it and all of that? But right now, at this current stage, the current machine is still a better option financially. Any questions on that one? I think the only thing to remember when you're looking at replacing equipment is that you consider all, you know, all 5 years of the labor costs, but they kind of prompt you for that, so not too bad. Let's see. Next one, we're looking at processing something further or selling it as is. So in this case, we have product J19. It's produced for $11 per gallon. It can be sold as is for $18 per gallon. Or we can take it and process it further into product R33, which costs an additional $7 per gallon. But then it can be sold for $24 per gallon. So should we continue, or should we just sell it as is, or should we process it further into this next product? And of course, there's other information that would go into this, like demand of both of those products, which we're not getting into, but we're going to assume there's demand for both products. So in this case, if we sell product J19 as is, it told us it can be sold for $18 per unit, and the cost is $11. So right now, if we sell it as is, we would make $7 per unit. To further process it, our revenues would increase. We would go up and make $24 per unit, but it would cost us $18 total to make it, because we have the original J19 processing cost of $11 and then 7 more additional dollars to get it all the way to R33. Okay, so those variable costs are relevant. So if we process it further, we make $6 per unit. So which one's better? Yeah, if we sell it, we make what, $1 more per unit. And again, we can see that by doing the differential effect. Our revenue is $6 higher under alternative 2, but our costs are $7 more. So all total, we would see a loss per unit of $1 if we chose to process it further. Again, you know, in accounting, this is just crunching the numbers. looking at assuming that both products have equal demand. If our customers didn't want oh my goodness, product, it's in my head now, product J19, it would be silly. You know, we would have to be able to sell it, right, for this to make sense decision-wise. So as an accountant, sometimes we're doing the math and showing what the options are, but then, you know, production and sales would also need to get together and decide, is this a viable decision for our company? Do we have enough customers that are demanding product J19, or are people wanting this product R33? Because if we're not selling product J19, then it doesn't really matter if we produce more, right? So it's important to look at like the big picture there too. Or if there was, you know, if it took longer to produce J19, you know, there's other factors that go into play here. But again, just looking at them as if they were equal, it makes sense to just sell product J19 if possible. Any questions on that one? All right. So the very last one, looking at special orders. Hold on, sorry. Okay. So in this case, we're looking at a special order. So again, when we're looking at special orders, we really want to look at variable costs. We don't want to consider fixed costs because we have to pay those regardless. So sometimes we can sell things for a special price and still make a profit. We just need to consider it. So product A is normally sold for $9.60 per unit. A special price of $7.20 is offered for the export market. The variable production cost is $5 per unit. An additional export tariff of 15% of revenue must be paid for all export products. And we're going to assume there's sufficient capacity for the special order. So when we're looking at special orders, number one, we want to make sure we have capacity in our factory to take it on without impeding any other orders. The second thing we would want to look at is we want to make sure we're able to cover all the variable costs. Okay, so variable costs are the only relevant costs. So the variable production cost and of course that export tariff. It is $2.40 less per unit than what we normally make, plus that export tariff. But again, as long as we're making more than the variable costs and the export costs, then we're doing pretty good. So if we reject the order, obviously we have nothing. You know, we have no revenues, no costs, no tariffs, no income, right? Rejecting it, we get nothing. If we accept it, we know we're making $7.20 per unit in revenue. And then our variable manufacturing costs would be $5, so minus 5. And then we would want to calculate 15% on $7.20. So our tariff fee on every item would be $1.08. So all total, our costs are $6.08, which still lead to an income of $1.12 on each item. Okay. So in this case, we should accept the special order because we're actually making income of $1.12 on every item that we sell to them. And special orders are kind of unique in that usually when someone purchases a special order, it's a guaranteed sale. So it's not like we are producing all of these and then run the risk of not selling them. They've ordered it. So it's actually just extra income as long as it's an income and not a loss. So really over on the right-hand side, your answers are all the same. You would see an increase of $7.20 on revenues, a minus 5 cost, and a minus 108 for tariff, and an income of $1.12 per unit. So with special orders, we talked about it in another chapter, I think, when we were talking about variable costing versus full absorption costing. When we're setting prices, we usually use full absorption pricing. Like we want to cover all of our costs, fixed and variable. So our cost should be set high enough on our products to cover those fixed costs. So when we're looking at a special order, well, again, we're already paying those fixed costs. So if we get rid of the fixed costs, we just want to look at if we're covering our variable costs and still making income, we're making income because we pay that rent, utilities, maintenance, all of that stuff gets paid regardless. So with special orders, again, we always just look at, do we have capacity? And are we, making money to cover, are we making a profit over our variable costs and any additional costs of taking the order? And in this case, we are. So we should accept that special order. Okay. And again, from an outside perspective or from an inside perspective person that's management and not maybe super adept at accounting, you might say, oh no, that's too low to take for this special order. But again, you always have to crunch the numbers, and we are still making money because the fixed costs are irrelevant. They're sunk. We have to pay them regardless. Now, if our factory was at capacity and we had to, expand labor hours and expand, operations that increased other costs, that would affect the special order more. And then we'd have to calculate it with those extra costs added in. Okay. Any questions on that? All right. Well, try to end on an easier chapter, right? Just so happens. Yeah, it's always nice.